Good morning, Robyn.
Hey, Paul, how are you?
I'm doing really good this morning, and welcome
Good.
all the folks that are joining us this morning for this webinar on the Employee Retention Tax Credit for 2020 and 2021. We hope to sift through some of the noise and diffuse some of the confusion about the Employee Retention Tax Credit with some good, solid information today to empower our clients and visitors with the information they need to take advantage of this particular program. Before we get started, though, just a little bit of housekeeping. If you're new to using Zoom, if you take your cursor down to the bottom of your screen, you'll see a toolbar pop up here at the bottom, and you may see both a Q&A button and a chat button. Just to help Robyn and I keep track of your questions and make sure we're getting answers back out to you, please use the Q&A button so that we're not having to switch between both Q&A and chat. That gets a little distracting when we're trying to make a presentation and keep up with the chatter that's out there. So please use the Q&A button. We'll be checking that during the presentation, and we'll be sure to stick around as long as it takes at the end of this presentation to make sure all your questions are answered, or if we can't get an answer, at least we can take down the question and follow up with you after the program. We are recording this particular program. Your camera is off, your mic is muted, so you don't need to worry about that we might be watching you, but we are recording the program. We will have that uploaded later today on our YouTube channel and also available for distribution, perhaps for people who weren't able to attend this particular session. So with that, a little bit of housekeeping, a little bit about Robyn and me up here on the slide. Robyn, you're in our Katy, Texas office this morning.
I am.
For folks who don't exactly know where Katy is, how far is Katy from, say, downtown Houston?
I'd say 20 miles.
Okay, yeah, so it's close enough. So it's west of Houston. Katy is, back in the day, we would have referred to Katy as a suburb of Houston, but I think today with the tremendous growth in that particular area, Katy's kind of a community in its own right.
Well, Houston is now a suburb of Katy. So okay. There you go.
Well, they say everything's bigger in Texas, including the stories they tell.
That's, right. That's fair.
Yeah, there you go. And I'm Paul Mueller. I'm the managing director of the firm, and I oversee our practice from our Loveland, Colorado office. However, today I'm in my office in Estes Park, Colorado. Some of you folks might have heard yesterday we had a little bit of excitement here in Estes Park. We did have a wildfire blow up about 2 miles east of our home. And we were watching it with a lot of interest yesterday as the fire raced up the mountain. Unfortunately, it topped the mountain with the winds that we had, and I believe is still burning east of Estes Park. So there's been some mandatory evacuations east of here. I just felt it was prudent to kind of stick around today because you don't know when the winds change up here. And we just need to stay close to home and be somewhat prepared. We don't think anything's going to happen to us, but we just want to take that extra bit of caution today. And that's the beauty of being able to work remotely and be able to provide these webinars on Zoom. So before we get into specifically the Employee Retention Tax Credit, which you see is on the bottom of this list, I thought it might be helpful just to step back for a little bit and comprehend all of the pandemic programs that we've had to learn, communicate about, and take advantage of through the pandemic. And this is a list of all the federal relief programs that have been launched since the pandemic really hit in full force around the middle of March in 2020. This does not take into account programs that individual states, municipalities, chambers of commerce, industry associations, all those programs that were launched to help assist local businesses or trade members of a particular industry. This is just the federal list of these programs. And for the most part, most of these programs have either run out of money, run out of time, or run out of both. And the three that I highlighted on the page here that I just wanted to touch on briefly. The first two is the targeted idle advance. You might remember early in the pandemic, there was the $10,000 emergency idle grant that you started the process of applying for an idle loan. You stopped at phase one and asked for your grant, and that money was sent out to you. It was supposed to be $10,000. And then the SBA changed the rules at the last minute and said, no, it's $1,000 per employee up to a maximum of 10. And that kind of made some business owners, I mean, it seemed like a bait and switch at the time. So at the end of 2020 in the Taxpayer Certainty Act, Congress refreshed the idle advance program, but they put a target on it that your business has to be located in what they refer to as a low income community. And SBA has a map that you can put your address into to find out, do you qualify? Are you located in that? And then you had to have demonstrate a significant revenue decline compared to what your revenues were in 2019. And they increased the advance program up to $15,000. So that program, though, runs out December 31st of this year. So if it's not something you've looked into, it would be really good to go to the SBA.gov, search on the title Targeted Idle Advance Program. And again, use the interactive map to see, first of all, are you located in a community? And then can you meet the revenue decline test in order to apply for an additional grant? Just like the PPP loan, these advances are tax-free income, and you don't have to pay it back. So something to really look into. If you have any questions or you need help finding that map, that interactive map that the SBA has, certainly reach us. And at the end of the program, we'll talk to you about how you can reach out and contact us. The other item I've got highlighted there is the idle loans. And the idle loans have gone through a significant transformation since the pandemic began. Originally, those loans, I believe, were capped at $150,000. Later on, the SBA then extended the cap to $500,000. And then in September, towards the end of September, they made a couple of really big changes to it. First of all, they upped the loan limit to $2 million, and they added a provision that you can now use the loan proceeds to pay off other debt, basically using the idle loan mechanism as a refinancing tool. And the fact that the loan has a 30-year maturity, it's a fixed interest rate of 3.75%, and payments are deferred for the first 2 years. So you're basically paying the loan back over 28 years. It's the first 2 years that you don't have to make any payments on the loan. Now, the interest is accruing on the balance, and you'll eventually make that up. But to have a 2-year runway of not having to make any payments on this loan, an opportunity to refinance your entire debt structure into a 30-year loan with 3.75% fixed interest is a phenomenal opportunity for businesses that want to pursue that type of lending opportunity. So those two programs are still in place. The idle loan program will be in place as long as there's money in the fund. So there's not a time deadline on it, but if you wait too long and the money's already lent out, then you may be too late to the dance. So take a look at those two items if you think those are available to you. But going to the bottom of the page, we're going to jump in and we're going to talk about the employee retention tax program, which Robyn and I have talked about. This is like, the more we learned about it, this is like one of the most lucrative pandemic relief programs, yet one of the most complex of the pandemic relief programs, and one where there's been a tremendous amount of confusion over how it actually applies and what it means to a business owner. So with that, Robyn, as a lead, and I'm going to let you share where did all this confusion come from?
Well, I think probably the biggest reason is that the rules have been changing and changing and changing, and it's been difficult to keep up with for us. Also for the small businesses that are just concerned with keeping their doors open. I think the original version of the ERTC, you couldn't utilize that if you got a PPP loan. Well, everybody was getting a PPP loan, so the ERTC was ignored. And by the time, excuse me, by the time that rule changed late in 2020, I think people were done with this alphabet soup of PPP and ERTC and all of that. And people just were done. I think the other thing is, you know, the ERTC is a payroll tax credit, so it's claimed via an amended payroll tax report. So I think some of the CPA community was looking to the payroll company saying, well, it's a payroll tax credit, they'll handle it. And then the payroll providers were looking at the CPA saying, we don't have the information to even determine if someone's eligible. So you guys take care of it. So I think there was kind of this, not finger pointing, but just nobody knew who's on first, what are we doing?
Yeah.
So, and, we know that this is true. We know this has been so underutilized. Paul and I spoke at a conference in Colorado a few weeks ago, and 75% of the business owners in the room had never even heard of this thing. So people are not taking advantage of this. So Paul, go ahead.
Well, and Robyn, I've been practicing for more than 40 years, so I'm kind of dating myself here a little bit. I think I knew there was a 941X form that you use to amend, but I've never, up until ERTC, I never did one. So
right.
Yeah, I mean, it's
I don't guess I had either.
Truly been a learning exercise, that's for sure. So where did this all start?
So back in March of 2020, so the ERTC was originally part of the largest economic stimulus bill in US history, March of 2020. And that was the bill that was the CARES Act. And so that's where the PPP loans came from, the stimulus checks that were issued to certain individuals, and the ERTC. Later that year, it was modified, and I love Paul's wording here. He is known as the word God in our office, and he uses enhanced and modified and extended by the Taxpayer Certainty Act in December of 2020. And really what I see when I look at that is it was muddled, it was confused by the Taxpayer Uncertainty Act of 2020. And then it was further extended and modified in March of 2021. So that's just a tiny bit of the changing guidance that we've been seeing. And then there's been rulings and notices and other things that have played into that. And then again, this was largely ignored because in March of 2020, when the original came out, they said, well, if you got a PPP loan, you don't qualify. So nobody paid attention to this thing.
And Robyn, you and I remember those days, gosh, that March and April time period. When we looked at it, it's like, hold on a second. We can either advise our clients to go get a big chunk of money, which was the PPP loan, which is tax-free, doesn't have to be paid back. I mean, it's a big chunk of money now. Or you can sit and wait for this $5,000 tax credit to sort of eke itself out of, and we were like, no, go get the money. And that was our approach.
Yeah. So we've had three big changes in this ERTC. So let's take them one at a time. So I'm going to talk a little bit about the original ERTC or ERTC 1.0. So the initial eligibility. So if your business was, fully or partially suspended by government order, or you had this reduction in gross receipts, then you were eligible for the ERTC. And we're going to talk more in a minute about what full and partial shutdown mean. So, but for the gross receipts, so let's say that for the second quarter of 2020, your gross receipts were $100,000, and second quarter of 2019, your gross receipts was $200,000, then you qualify for this credit. The credit is calculated as it's 50% of your wages up to $10,000, but it can't exceed $5,000 per employee. And then eligible wages run from 3/12 of 20 through the end of December 2020. But again, this first version, if you got a PPP loan, you weren't eligible.
And so, yeah, you and I just sort of cast this aside. And I don't know that we paid 5 minutes worth of attention to it in 2020. It just wasn't viable.
The PPP loan was absolutely the better deal. So that's the direction that, we advised our clients to go.
Okay, so one of the probably most confusing aspects of this is what the heck is a full or partial shutdown?
Well, so we'll talk about that. And you'd think a full shutdown or full suspension would be pretty clear cut, but not necessarily. So it has to be a government order, so a government mandate. It can't be a suggestion or a recommendation. So if you're ordered to shut to close your doors and it caused your business a form of disruption, then you qualify. So let's say, like for us, we were considered essential, so we could continue to keep the office open, but In Colorado, it may have been different. I think, didn't you guys have limitations on how many people you could have in the office
Oh yeah, I mean
at one time?
it varied at times, and I believe there was even a time where we had to be closed
Okay.
and go remote.
So that would qualify as a partial suspension, but it didn't cause us a disruption because we were able to pick up and work from home. So if you were able to kind of relocate or shift your business, your people just moved to home, then you don't qualify. That doesn't qualify as a full or partial shutdown. But let's say that you're an essential business and you stay open, but you lose the ability to obtain goods or materials from your suppliers because they were required to suspend, then you might be eligible for this ERTC. So there's a lot of complexity in determining who was shut down and who wasn't.
And here and Robyn, here in Colorado,
Yeah.
well, like with some of our bars and restaurants, who were some of the early victims of some of these
Yeah.
suspension rules. There was a time where you had to have last call at 8 p.m. Well, typically bars can stay open until I think like 2 a.m. Here in Colorado. So the fact that they had to have last call at 8 p.m. and then close at that point,
Mhm.
that was a limitation on their operating hours, and that qualified as a partial suspension.
Right, as did limitation on capacity. So restaurants that couldn't be more than 25% or 50%, that qualifies as a partial shutdown. So you qualify for this ERTC. Same if it was a restriction on the services where you could do outdoor dining but not indoor, you could do takeout but not indoor dining, seated dining. That also qualifies as a partial shutdown. And the IRS actually has a really good frequently asked questions section about what qualifies for a full shutdown or partial shutdown. So there's good information out there, and they get pretty specific about what qualifies and what doesn't. So in a nutshell, that was a really quick overview of ERTC 1.0. So Paul, are you going to jump in and talk about the revisions that came in December of 2020?
Yeah, so let's talk about ERTC 2.0, which is the Taxpayer Certainty Act, which Robyn refers to as the Taxpayer Uncertainty Act, that was signed into law on December 27th of 2020. So, here it happened in the middle between Christmas and New Year's, and you're right, Robyn. I think people had pandemic fatigue, and this just sort of got lost in all the noise. So, I broke it down earlier about extended, enhanced, modified. So let's break that down a little bit. So the ERTC was extended by this act. It was extended into the first and second quarters of 2021. They also implemented this look back rule that if you qualified in the immediately preceding quarter, and we'll talk about what qualifying means here in a second, in the preceding quarter, you automatically qualified in the succeeding quarter. So for instance, you could compare your quarter 4 2020 revenues to your quarter 4 2019 revenues. And if you had more than a 20% revenue decline, that automatically qualified you for the first quarter of 2021. So instead of having to wait and see if the first quarter actually had a revenue decline, you could actually claim the credit in advance, knowing that the prior quarter qualified you for that first quarter of 2021. And the same rule applied. If the first quarter of 2021 met that revenue decline test, then you automatically were eligible for quarter 2 as well. So they were trying to speed up the ability of people to actually begin to implement the employee retention tax credit. But there was a little fly in the ointment there, and I'll touch on that in a little bit. They also enhanced the credit. So Robyn talked about the credit was 50% of the first $10,000 of wages paid to an employee that qualified. Well, they increased that rate from 50% to 70%. So now it was a $7,000 credit. Further, under the original ERTC 1.0, it was a $5,000 credit for the entire year 2020. That was it, $5,000. When they enhanced it at the end of 2020, they not only increased the credit to $7,000 per employee, but it became $7,000 per employee per quarter. So at this point, the credit jumped to a maximum of $14,000 for those first 2 quarters of 2021. And again, like I said earlier, they reduced that required decline in revenues from 50% to only 20%, as to make you eligible to claim this credit. They also modified it by saying, that prohibition on PPP borrowers to take advantage of the ERTC, we are going to retroactively take that off the table. So here on December 27th, folks, if you want to, you can go back all the way through 2020 and claim the tax credit on a retroactive basis. But they put in there, though, the wages that you use to obtain full forgiveness on your PPP loan, those wages can't also be used to claim this employee retention tax credit. And so that kind of brought everything to a full stop. That was kind of the fly in the ointment, because it's like, well, hold on a second. Wages are somewhat fungible. How do you decide which wages were used to get forgiveness on the loan and the wages that are eligible for the credit? So we had to wait for some rules on that to figure out what the heck does that mean. So again, it created some additional delay on getting on this right away. Plus, there were a lot of people that got their second PPP loan in January, February, March. And so again, going out and getting that PPP loan, that sort of slowed down what they could claim for the ERTC going into 2021. So just again, a lot of confusion here that we really had to kind of wade through. And they weren't through. As Robyn mentioned, the American Rescue Plan back in March of 2021 tinkered with the ERTC again. So I refer to that as ERTC 3.0. That bill extended the ERTC even farther into 2021, into Q3 and Q4 of 2021. But as we just found out, or we knew it was coming when President Biden signed the Infrastructure Investment and Jobs Act on Monday of this week, in that bill was a provision to repeal the retention tax credit for the fourth quarter of 2021. So it's still available for the first 3 quarters of 2021, but they did claw back and take that fourth quarter off the table. So now the maximum retention tax credit for 2021, now remember, the maximum tax credit in 2020 was $5,000 per employee. Now with the ERTC 3.0 being in effect for 2021, that maximum tax credit is now up to $21,000 per employee. The other thing the American Rescue Plan created was something called a Recovery Startup Business Credit. And this was in response to a lot of concerns in the business community that all these pandemic relief programs were put in place to benefit companies that were in existence before the pandemic hit. Typically, February 15, 2020 was kind of like a marker that if you were in business before that date, you could take advantage of all these programs. If you didn't start your business until after February 15, 2020, there was nothing in it for you. There was no relief, no benefit. So this Recovery Startup Business Credit was created to specifically benefit businesses that launched after February 15th of 2020. It's similar to the ERTC, but a little bit different. It applies for quarter 3 and quarter 4 of 2021. And it's a maximum credit that's capped at $50,000 per quarter, or $100,000 for the whole year. So if you have a startup business that started after February 15, 2020, and you thought, there's just never anything in it for me, this is truly a valuable credit that may go a long way towards helping these companies that launched at the worst possible time to try to get back on their feet and keep their operations going. One thing we hear about sometimes is, this stuff is confusing, it's changing, it's complex. Is it really worth it? What's in it for me with this ERTC? And so I just wanted to illustrate here what we've seen with our clients. And by the way, let's see, since February, we have filed more than 70 refund claims for our clients. And the total refunds we've requested are in excess of $3.5 million right now. And we think there's a lot more on the table. And that's why we're actively trying to get the word out for this. But this is one particular client. It's one of our brewery clients down in Denver. When we looked at their 2020 employee retention tax credit, like most breweries, brew pubs, bars, kitchens, anything in the food and beverage industry, they were on some kind of full or partial suspension from the time the pandemic hit in mid-March all the way through 2020. So they qualify for the entire calendar year. They did go get a PPP loan of $118,000. Their total wages for that time period from March 16th to the end of 20 was $409,000. We were able to prepare and file refund claims for them for $100,000. That was a nice little boost, nice little benefit for them. But then going into 2021, most of our food and beverage businesses were on some kind of partial suspension up until about Memorial Day weekend. And then after that, we look at whether the second and third quarter qualifies based on the revenue decline. On their 2021 ERTC, just to show the magnitude of the dollars that are involved here, and this says all 4 quarters qualify, but as we know now, it's just the 3. They did go get a second PPP loan early on in 2021 for $164,000. Their total wages for the first 3 quarters of this year were $464,000, pretty similar to what their wages were in 2020. And we just got through filing refund claims for all those 3 quarters for another $205,000. So, depending on what your numbers are, depending on your facts, we do believe there are significant dollars on the table for this particular credit. See, Robyn, do you want to? Oh, okay. I'm going to talk about. So, one of the things Robyn talked about is Congress kept changing the rules. Well, the IRS kept kind of shifting around on some of their guidance here. Early on, though, they did issue some FAQs that Robyn talked about that got into things like full and partial suspension and wages and eligibility. They were on it pretty quick with some preliminary guidance. And the one that we really focused on was FAQ number 59, which said wages paid to an employee who's related to the owner, that person's wages can't qualify for the tax credit. So, if you gave your younger brother Johnny a job to hose out, say, the brew house because your mom wanted him out of her basement, that was a nice thing to do for mom, but Johnny's wages aren't going to qualify for the retention tax credit. The IRS then waited almost an entire year to issue some guidance with Notice 21-20, where they gave some examples that helped fill out what a partial suspension looked like. So they gave us some really good examples that we were able to follow. They issued some rules governing the interplay with PPP loan forgiveness on how to, what wages were used for PPP loans versus the wages eligible for ERTC. And so that's what sort of like jump started us. Once we understood how the IRS viewed that interplay, it gave us the latitude to get going on this stuff. And that's when we started filing these refund claims. In April, there was another notice they issued talking about how to apply the rules to the extended tax credit into Q1 and Q2 of 2021, but not really a whole lot that was new on that. And then the bombshell. In Notice 2021-49, that this was issued early in August. I was about a week away from going on vacation, and this pretty well shook things up. They did give some guidance on how to claim this recovery startup business credit, and that was fine. They did do one good thing, and they confirmed that tip wages are wages eligible for the retention tax credit, which was the position, Robyn, you and I took all the way along for a lot of our brewery clients and some of the food service clients. Our reading of the law, it was pretty clear that tip wages were eligible for claiming the ERTC, but there was a lot of controversy in the CPA community about that. So IRS clarified that was a win for the food and beverage industry. But the thing they dropped on us was this. I gotta be nice here. They dropped this rule on us, and Robyn, you're going to get into this a little bit more. But they came up with this rule that the owners and the owner and their spouse wages in certain circumstances did not qualify for the retention tax credit. And so I'm going to tee you up on that one, Robyn, and I can't use good language on this, so I'm going to turn this one over to you.
You're going to make me talk about it.
Yeah,
Thanks,
you got
Paul.
to talk about it. I'll get mad.
Appreciate that. It seems too crazy to even talk about, but you guys are just going to have to trust that the ridiculous words that are about to come out of my mouth are true. So here's what the IRS said in this notice. They said, if you or your spouse own more than 50% of the business and you have living relatives, excuse me, then neither the owner or the spouse's wages are eligible for the credit. So if you have no living relatives, go ahead and take the credit. But if you have living relatives and you or your spouse own more than 50% of the business, you don't get to take the credit. And it doesn't matter if those relatives work in the business or not. Just the fact that they live on the earth disallows those employee and spouse wages for the credit. So, initially there's a lot of related party rules within IRS code because they don't, so in this instance, they don't want you to go out and hire every member of your family and then take the credit for those wages. But this doesn't have anything to do, this just goes so far the other direction, it's ridiculous. So a lot of members of Congress are upset. The CPA community has voiced its dissent. Business owners, it's ridiculous. So then the question becomes, well, is this notice going to stand, or is Congress going to do something and change the rule? This can result in a loss of $33,000 per owner and their spouse. So huge numbers. So, we don't know. A lot of folks are lobbying for reversal. Congress members are upset and don't agree, but we'll just have to see what happens. So a couple of different options. You can, so here's the dilemma. Since it's published guidance, you can face stiff penalties for filing a return that goes against written guidance. And so you've got a couple of options. You can go ahead and file the refund claim as if the notice will be reversed, but you have to disclose that you're taking a position that's contrary to published guidance. The purpose of disclosing that you're taking that contrary position is to avoid those hefty penalties, should the IRS choose to look at that return. Or you can go conservative, file the refund claim, disallowing the owner and spouse wages. And then if this notice is reversed, you can go back and amend. So those are the two options that we've been presenting to our clients, and just, letting them choose depending on their tolerance for risk. But the vast majority, I think probably 70% of mine have gone aggressive and said, we'll disclose it, but we're going to take the position that it's going to be reversed because it's so ridiculous, and cross our fingers and hope that comes to pass and see what happens. So Paul, are a lot of the folks that you're working with, what's their thought on it?
Yeah, since this came out in August, we've been offering every client one of these two alternatives and saying, which one do you want us to follow? And I think you're right. I think I was thinking about 70% have said, let's go for it.
Yeah.
There's been a few that look, let's get what we can now, and if we can go back and amend later, if the rule changes, then we'll get some now, get some later. Kind of an approach, but it's I guess the important thing is to have options, and it's our job to communicate what those options are, and at the end of the day, it's the client that has to make the call as to which of those options they want to go with.
Right.
So how do you claim the ERTC? And Robyn, you mentioned this early in the program because it's been an area of a lot of confusion. The retention tax credit is a refundable payroll tax credit. That's why you file it on an amended 941, which is the quarterly payroll tax return. It's not it's not an income tax refund that you can apply to your personal return or to your business tax return. It's a payroll tax credit. So the only way it's going to show up is when you get a check in the mail. It's not going to be a credit to put anywhere on the tax return. You claim it after you identify to what extent you're eligible in 2020 or 2021 to claim the credit through either a revenue decline or this full partial shutdown type of rule. And sometimes both of those apply at the same time. And again, you file the 941X and the IRS will process and eventually issue refund checks by mail. But Robyn, that's been a little troublesome or a big problem that you're going to talk about in just a little bit. One thing I did want to talk about is we did have so many clients that were PPP loan borrowers that there are these special rules and considerations in claiming the credit. And for those that most people have filed their PPP forgiveness application by now. If you haven't filed your forgiveness application, you want to minimize the amount of wages you put on that PPP loan forgiveness application, because the IRS guidance says whatever you report on that forgiveness application as wages to seek forgiveness, those wages absolutely cannot be used for the retention tax credit. And as you recall with some of the rules, you only needed enough wages to equal 60% of the PPP loan to have that loan fully forgiven. Of course, that assumes you have the 40% of cost for things like the interest, the utilities, rent, and there's some other items there, that you had enough of those non-payroll costs to fill up the 40% bucket, that you only needed to report wages equal to 60% of the loan. So there's a strategy there to minimize the wages you use for forgiveness so that you are maximizing the wages for ERTC calculation purposes.
Paul, I'm going to interrupt you for a
go ahead.
second, though. So one thing that stinks about 2020, March of 2020, you're not eligible for this thing if you got a PPP loan. December of 2020, you're eligible if you got a PPP loan. Well, so many borrowers had already filed their application for forgiveness. And if they could do if they had enough wages to fill the whole thing and to get full forgiveness, it eliminated a lot of paperwork that they had to submit to the lender. Yep. So they would just use all wages, submit payroll, and be done with it. And that turned out to be, not to their benefit, but who knew? I mean, that's been so unfair, but is what it is.
Yeah. And, I had a client that had filed, I asked them for a copy of their forgiveness application, and this was like 9 o'clock in the morning. At 10 o'clock, he emails me a copy of his forgiveness application, and I'm looking at it, and it's date stamped that day at 9:30 a.m. and with a DocuSign thing on it. And so I called him right away. I said, did you just file that application? And he was like, yeah, you asked me for a copy of it, so I thought I ought to go ahead and fill it out and send it in. And he had put 100% wages equal to the loan. Mm-hmm. I was like, give me the name of your banker. So I called her. She was here in Estes Park, and I said, listen, is there a chance for us to yank that back? Can we take it back? And she said, let me call you back in a few minutes. Let me see. And she goes, no, once we got it, we sent it through the SBA portal, and SBA says once it's filed, there is no amendment. There's no yanking it back. There's no mulligan here. Mm-hmm. And so that cost him about, I think it was like $22,000 in tax credits we could have claimed.
Ouch.
So just those self-inflicted wounds. And it was a real shame to see some of that. I mentioned down here about cherry picking wages, and this is really important. We've talked to you about that if you have an employee who's a relative, that person's wages can't qualify for the tax credit. IRS has said majority owner wages can't qualify for the credit. And if you follow along with that guidance, if those two types of wages don't qualify for the ERTC at all, well, then you would want to make sure you cherry pick and apply those specific wages against the PPP loan, because that qualifies, and free up wages from your other employees that might help get you to a larger tax credit. So there's a lot of gamesmanship and interplay here that takes place, but there are ways to cherry pick to maximize the credit that you're entitled to. Yeah. Let's see. Oh, and Robyn, you're going to talk about some of these processing issues we've encountered.
Yeah, so we had a lot of clients that filed back in April and May, and they're just now starting to receive refunds. They're starting to trickle in. So it's taking a good 6 months for the IRS to process these claims. So this data is a couple of weeks old, but as of October 27th, almost 400,000 unprocessed claims. I'm sure the number's higher now.
I was going to say, let me stop you. I went on the IRS site. Yeah, the IRS has like a counter. They're keeping track of these things. So as of November 10th, which was what, Friday? was that Friday or Thursday of last week. As of
Yeah.
November 10th, the backlog was 392,000 unprocessed 941X returns. So
It's growing
it
fast.
continues to grow. Yeah.
Yeah. One thing the IRS has done, they're starting to redistribute the claims among various centers. So hopefully that's going to help speed things up. You know, what's frustrating normally, there's IRS has a practitioner priority line. So if you're a CPA or an enrolled agent, you can call this special number and usually get assistance a little quicker than just dialing 1-800-1040 or whatever the general number is. But there's nothing in place for this. And so we can't even check to see if the IRS has received the amended return, much less where it is in the, in the pipeline. So that part is really frustrating, but certainly not, you shouldn't let that be a deterrent from pursuing this. It may take a while, but eventually, eventually you'll get your money. And the little tiny silver lining is your refund claims are earning 3% interest, and IRS is paying that interest along with the refund. So that's the good news, I guess, if anything, on this on this slide.
Yeah, it beats money market rates, but I think people would rather have the money.
Yeah, exactly.
Yeah,
Well,
I think
this is supposed to be, pandemic relief. And when folks are having to wait 6-8 months for their money, I mean, some businesses may struggle to hold on that long.
Right. It's not much relief when you have to wait so daggone long. That's for
that's
sure.
the frustrating part. So Paul and I have thrown a ton of information at you guys. So let's just from 30,000 feet talk about maybe what do I do now with all of this information? So I think the first thing, just identify which periods you think you're eligible for. And Paul's going to talk in a minute about how you can get in touch with us. Even if you're not a client, we'd be happy to take a look. So if you're a desktop user, you can send us an accountant's copy with the dividing date of end of third quarter 2021. If you're on QBO and you're a current client, we're reviewing that information soon. We've got it together. We've started the process, and we'll be reaching out to identify those clients that are eligible for this credit. So then, determine your eligibility period, and then pull out the wages that you used for PPP loan forgiveness. And then if you want to run a really, really rough feasibility analysis for 2020, take those eligible wages that are left, divide by your number of employees, cut it in half a couple of times, cap it at $5,000 per employee, and there's your rough refund claim.
Did we say rough?
I said rough a time or two. Yeah. Hopefully folks are getting the point. And then for 2021, take those eligible wages after you've backed out, owner's wages, related party wages, PPP wages, divide by your number of employees times 70%. And that's going to get you a rough estimate. It is not too late. So you have 3 years to file a 941X after the original filing. So you've got time. It is not too late, but obviously with the backlog that the IRS is facing, the better, the sooner you can get it in, the better off you're going to be in terms of just getting your money.
Yep. And then as far as, what our fee structure has been for filing these refund claims for a 2020 employee retention tax credit study, since that's done on a full year basis, the fee for that is a $2,500 base fee plus $100 per employee, but in no case does our fee exceed 15% of the actual tax credit claim that we're filing. So there is a cap there on a percentage basis. And then for 2021, because that's a quarter by quarter calculation, we discounted our base fee down to $1,750 base fee plus the $100 per employee, not to exceed 15% of the ERTC. So, if you wound up qualifying for 2 out of the 3 quarters, then that fee applies for each of the quarters that we have to calculate the credit, prepare the refund claims, and get those sent in. So that just gives you a little bit of, I think, what Robyn's given you with that rough calculation. You can kind of run that on your own, sort of get an idea what ballpark you're in. Here's the cost side, so you can hopefully this information kind of helps you do a little bit of a cost benefit analysis here to see if this is something that's worthwhile moving forward on. Robyn, do we have any questions that have been sent in?
I don't see anything. We told them to use the chat, right? I see nothing in the chat.
No, I told them to use Q&A.
Oh, I wasn't paying attention at the beginning of the presentation.
Well, you weren't listening to me, which
I wasn't listening to you.
nothing.
I see nothing. No open questions.
Okay. Okay.
No
well,
answered and nothing dismissed.
Well, then maybe we were so clear in our
Right.
in the information we provided that we answered all the
It's
questions.
either that or everyone's asleep.
Yeah, that's
by
right.
now.
So I wanted to close up here a little bit and share a few resources here to learn more with the information here. And I do see, Robyn, we did have one question hit here, but let me go ahead and cover some of these resources first. If you haven't, be sure and subscribe to our Have an IPA with a CPA YouTube channel. This recording, once we download it and publish it, we're going to be putting it out there on the YouTube channel for retrieval. Also, we have a significant amount of COVID resources on our website, and I've got the link here, but I'm going to do a little bit of show and tell. If I figure out how to get to the right screen, here we go. So here I'm showing, I hope I'm showing, Robyn, you see the Have an IPA? Okay, so this is our Have an IPA with a CPA YouTube channel. You can just probably Google search Have an IPA with a CPA and it'll bring you here. There's just a ton of material here, videos that if you didn't get enough of Robyn and me today, there's like an unlimited supply here of more chatter between the two of us on just a number of different types of topics. All of the webinars we did last year for the pandemic, those are all out here as well. So we invite you to take a look there and subscribe to our channel, because there'll be more material forthcoming. And then I refer to our resources page on our website. So our website is mpa.cpa, and there's a COVID page under the resource category, and there's just a whole host of material here and announcements going back to the very earliest days of the pandemic. If you haven't filed your PPP forgiveness application yet, we still have those calculators out here to help you come up with those numbers to make sure you get as much of the loan forgiveness possible. And then if you don't go to the YouTube channel, we do have a webinar page on our website where we have some of our webinars. These are mostly the pandemic webinars that we did that are out here on our website as well. So plenty of places there to find that kind of material.
Paul, you want me to jump in? Let me answer some of these questions out here. So, so the first question is there a way to find out if we've received a credit unless we have already gotten a check? Unfortunately, no, there's no way to call and check the status to find out if that check is in the mail. Our hands are tied. So that stinks. Hopefully the IRS will have something in place soon.
Yeah, and Robyn, along that point, let me go back to the IRS website where they're keeping score on these things, because they do say, please don't file a second tax return. So, if you think maybe your return didn't get processed or it got lost in the mail room at the service center, they're asking you not to file a second tax return, because that will likely disqualify the first one that you sent in. So, hopefully there will be a lookup feature at some point so we can begin to figure out where these claims are in the IRS.
Okay. And then the second question is the gross wage comparison on the previous year quarter, i.e. 2021 to 2020. So it's a gross revenue or gross receipts comparison that we're looking for, not a gross wages. But the gross receipts comparison would be 2021 to 2019. The idea being that 2019 was the last normal year of business. And so you're looking back to that time period. Once the refund money has been received, are there limitations or future considerations for how the money can or should be spent? No, so you can do with the money what you need to keep running your business. And then for the revenue decline eligibility in 2021, are we comparing 2021 to 2019? Yes.
Yes. Yeah.
I think that's it for the questions. If I wasn't clear on anything and you ask one of those questions, certainly feel free to, jump in there and I can clarify. Other than that, I don't see any more questions,
Okay.
but Paul's given you the resources here.
Yeah. And that's what I wanted to talk about in terms of
Oh,
email.
the phone number's wrong on here, Paul.
It is?
Thank you, Melissa. 665-7973.
Oh, okay. I'm gonna. Well, the Colorado number, the Colorado number's correct. I can assure you that. Okay. Well, that
you're blaming the Texas folks. I get it. I see how you
no,
are.
I fat fingered that, I'm sure. But the other thing I wanted, as far as emailing us, it might be easy. We do have a specific mailbox that we set up for COVID related types inquiries, and that's COVID@mpa.cpa, and we do monitor that inbox so that we're getting that information out to y'all as quickly as possible to answer specific questions that you may not want to ask in this webinar. Robyn, it looks like maybe a couple of other questions or another question might have popped in.
This one's interesting because I had this question come up a couple of days ago and I was actually researching it to double check myself this morning. So I'll tell you what I think the answer is and then Paul can check me. So
okay.
She says, if I file on the cash basis, do I use gross receipts or billings? So in other words, do I use cash basis or accrual basis? I believe that you use whatever accounting method you file your taxes on. Paul, is that correct?
Yeah, I agree. I think SBA came out with some guidance on that a while back. That
I think so too. And then this morning I couldn't get my hands on it, but I believe it's whatever. However, so if you're keeping your books on accrual but filing a tax return on cash, you would need to use cash basis accounting to determine eligibility.
Right. I agree.
Okay, and so someone says I basically had to let everyone go. So my son and I stayed on. My husband owns the business 99%, took back staff when we got the PPP and then laid off again because we had no business. So basically we do not qualify since all the wages were family. I guess.
But for the time they hired back employees,
right.
It sounds like there's probably an opportunity there.
I would say that would be worth looking at.
Yeah.
And again, you can take, if you've not applied for PPP forgiveness, well, even if you have, you can pick and choose which wages to fill the PPP with. So you would use the family wages for the PPP and hopefully leave those non-related party wages for ERTC.
Yeah, that's that cherry picking process that you can take advantage of.
Yeah. And then this is a good question, and maybe we didn't clarify, but it says, as it stands now, did you have to be shut down partially also in 2021 or just have the decline in revenues? So for both 2020 and 2021, it's one or the other. You can qualify because you had a full or partial shutdown or because you had the decline in revenues. So it's
well, I was just going to jump in. It's either or, but the rules, the wages under either of those two scenarios is a little bit different. So if you qualify for a particular quarter because of the revenue decline test, then all the wages in that quarter qualify for the retention tax credit.
Oh, yeah.
Yeah. If you don't meet the revenue decline test, but you did have a full or partial shutdown, then you take the beginning and the ending dates of that full or partial shutdown, and it's the wages during that shutdown, or the full or partial shutdown period. So there's two different sets of rules, and sometimes many of our clients were subject to both, and so it's a fact-driven analysis that we have to go through. And on that point, for our clients that qualify for the retention tax credit, we do have a very short questionnaire that we send out to have them fill out to identify, because everybody was different in terms of who was impacted by these health orders, which were shifting, all over the place. And so we really have to rely on the client in that full or partial shutdown area to tell us what those beginning and ending dates were, so we can zero in on that.
Yeah. So then one more question just popped up. Is the decline 20% for both 2020 and 2021 or just 2021? So for 2021, it's 20%, but for 2020, it had to be 50%.
So try keeping that straight in your head.
Yeah, no, I'm looking at you like, did I say that right?
Yeah, you said it. Yeah,
Nobody knows for sure if I did or didn't.
You said it right. You said it right. Oh, great. Well,
Oh,
Robyn, if there's
we still have quite a few folks sitting out there, so we might give it just 1 minute to see if any more questions come in.
sure, I'm kind of watching the
You're
clock here.
watching too?
Well,
Okay.
we're coming up on close to an hour.
Okay.
You know, and that's what we, kind of promised that that was going to be our time frame for that. But again,
Okay.
if there's questions that you didn't get a chance to ask or weren't sure to ask or whatever, again, we've given you all these resources. Please reach out to us, because
Yeah.
there, as we said at the outset, there is money on the table here, folks, and this is intended to help you not only survive the pandemic, but thrive emerging from the pandemic. So let's take advantage of these programs to help our businesses, help our employees, help our families, and help our communities, and take advantage of these resources that are available to you. So with that, Rob, I'm going to go ahead and we'll go ahead and close the program. We thank you for your time and attention today, and we're here. We're always here to answer your questions and be of help. So
definitely.
Everybody have a great day today.
Thanks, y'all.